Welcome to Gold Silver Pros, where you'll learn the ins and outs of the gold and silver markets. Searching for the best precious metals deal? Our affiliates are of the utmost trust, quality, and highest customer service in the industry. Shop with our trusted partner, �ル𝙊𝙇𝘿. Access special deals on silver, gold, and platinum through our website or call 307-264-9441.
Hello, everybody. It is 11 a.m. Central Time, so we're going to go ahead and get started. This is going to be just a Twitter Spaces. You guys have seen me do this before, and we just want to do it with our Twitter audience now that we've grown to about 20,000, to give a chance for you guys to come in and ask questions and have content like we do on the channel. We have a very special guest today. David Morgan is joining us, and he will be the co-host for the event. Welcome, David. I appreciate having you in. Feel free to chime in whenever you get everything ready and you're fully loaded. It's been an eventful couple of weeks in the markets. We've certainly seen a lot of risk on in the market, what I call risk on, a lot of geopolitical risk. The Fed, of course. People are wondering whether they're going to pivot or maintain course, and I think the entire market is waiting to hear what they're going to do. And we've also had a lot of big news opening up in the gold market about all of these countries and different areas of the world opening up gold exchanges, which has been a big development. And I think that has to do with the move towards, or the move away from the dollar as the reserve currency, and everybody gearing up for what the next system is going to be. We can certainly talk about that today. And we may do a little bit of preview of the Silver Symposium, which David and I will both be speaking at next week in Washington, Spokane, Washington area, which we think is going to be a lot of fun as well. For those of you who may be joining us at that event, we'll be happy to sit down and speak with you. I'm going to go over what I think is probably, the biggest issues going on in the market, and you guys feel free to chime in and let me know if you have questions. What I see in the marketplace is a ton of risk, but a ton of tunnel vision and people not looking at the risk. Of course, I'm a big macro guy, so I like to spend a lot of time looking at macroeconomic factors and those types of things, and how the world's going to go. So I have a longer term view. And one of the things that I'll be doing going forward is talking about some of the predictions I made and how they come about or haven't come about. But I see a whole bunch of risk, and I see the world realigning. Geopolitically, they're realigning. I think from an economic standpoint, people are realigning. And I think gold and silver are going to serve a really big role in that realignment. But I think we've got a lot of stages to go there yet. So people that ask me, Rob, where are the precious metals? How are they doing? What's going on with them? Why haven't they popped? What do we think is going to happen? I just tell people to stay patient. This cycle is a little bit different than the last ones. The cycles we had in the 80s, in 2000, 2008, and I would say even dating back to the 20s and 30s during the last big depression era are different. We're going through a currency regime change and a worldwide change. So everything's going to be different this time. It's not going to be the same old story. And so I think that means that we have to be aware of that and understand how the playbook could be a little bit different this time. And I think if you have patience, you will be rewarded. But I think there are bigger things going on in the world than just, hey, we're having an economic contraction and gold and silver need to go up. I think it's a worldwide liquidity event. And I think it's because the banking system's in big trouble, commercial banking system. And so I think right now the focus is not on precious metals. I think their day will come. I think people are freaked out right now about what's going on in the market and how difficult it may be for people to respond to this market and to navigate this market and to make sure the banks have liquidity and the businesses aren't collapsing. All right, it looks like, David, you are enabled. You are in speakers. You just have to unmute, and we can do the interview. How are you doing this morning, David?
A little frustrated. I was on about 4 minutes early, and the Spaces gives you got it. You're going to be recorded. Do this. You got that. You hit about 3 windows and agree to everything. And then in the past, I just show up. My little icon was there. And then from what I've had on about 4 or 5 Spaces I've already done, the host just clicks it and changes you from a listener to a speaker. Yeah. But that never happened. So I tried about 4 more times on the computer, and I finally gave up, and I closed it off and called in on the phone, and it connected right away. So,
yeah, so I appreciate you doing that. Spaces is a little bit finicky, I think. We ran a couple of these, David, in the last couple of months, and it's not quite there with some of the other platforms like YouTube and stuff. So definitely understand your problems. We've had those two before, but I'm glad you're in here now. So thanks for joining.
You bet. I kind of wanted to add on to what you said because I've listened, I've heard almost everything, and I agree. And not to be too dramatic, but this is not the kind of event we saw in 1980. I mean, what we saw from 1979 through 80, when silver went up over 850% and gold tripled. That was basically the concern that the U.S. dollar was done, and the Saudis just wanted, to rule the world with their oil clout. So there's a lot going on. There was also a war that started. All these things kind of combined into this feeding frenzy that took gold super high. But to me, that's a precursor to that kind of a combination of events on a global basis. So if you think that people could get excited and concerned, as it's already been in the record in in the last phase of the last bull market, compound that by a worldwide event, not just a United States event. That's my point. And those type of events don't happen every 50 years, like the currency comes out, and we off the gold standard for 51 years now. And that's part of it. But it's more of an event like the French Revolution. These type of things don't happen every 50 years. They happen every few hundred years. But I think that's what we're facing, Rob. And because of that, once the run to gold starts in earnest, it may be what Mike Maloney and others have said, unobtainium. I mean, it may be where the dealers don't take down their websites and don't sell what they have. That sounds far-fetched, but in a panic mode, people tend to react or overreact. So are we going to that? We're moving that direction. Will it manifest? As I said, I think it will. It could be more subtle than what I outlined and give it kind of an extreme case. But if you would have told somebody in January 1979 with silver at an all-time high of $6 to buy it, they would have looked at you, and it's high. It took 14 years from the time it left the coinage to get to $6. It was $1.29 14 years ago. Why the heck would I buy it at 6? And if you knew the future, of course, you would have made over 8 times on your money. So anyway, Rob, back to you.
Yeah, I appreciate that, David. And I appreciate, you've been in the markets for a lot longer than I have. And one of the reasons I wanted to have you on is to get that perspective. I think that I understand these events over time, but I think it's different living through them than it is just looking at the data afterwards. I think the data itself doesn't really tell the whole story. So in your view, David, what do you think is going to be the story for gold going forward? I mean, it sounds as though we both kind of agree this is a different type of event. Do you expect at some point, gold and silver to go through their blow off top phase where everybody's talking about them? Everybody wants to own some, and we may have even been talking about a precious metals bubble at that point.
Yeah, that's probably the hardest thing I struggle with, Rob, because one, the honest answer is I don't know. I mean, if you go back to 1980 again, the best thing you could have done was sell your gold at the top or near the top and put it in the 30-year treasury. And not only would you be making like 17% for 30 years, interest rates kept coming down during those 3 decades. So the bond's value increased and increased and increased. So it was probably the best investment you could make from a long-term perspective. That's then and now is now. This time it's different because the currency is being destroyed. We're in a currency crisis, which means whether you have a T-bill for a couple of months or a note for a couple of years or 5 years or a bond for longer duration, they're all worth less over time. And when the currency becomes worthless or perceived becoming worthless, which is most likely, then you don't really want to hold the long-term debt. And because of that, do you want to cash out at the top if it's a spike? And I'd say yes, you could cash out if and only if you get something of value. So you could cash out at the top for raw land, business, improved real estate, a hotel, apartment building, car lot, men's clothing store, you name it. But I'd be looking at something real tangible. So if gold's overvalued, and I've used this very corny analogy in the past, Rob, but the old adage that an ounce of gold over longer periods of time will hold its value. You can buy, a toga, sandals, belt in ancient Rome for an ounce of gold, and you can buy a fine men's suit today for an ounce of gold. So, okay, I'll go along with that. I think that's kind of a metaphor, but if you could buy a men's clothing store for an ounce of gold, now you know it's overvalued. And that's when you would obviously want to take advantage of that. But we're still very undervalued relative to the amount of money printing that's gone on and what the future holds with the potential for a reset with central bank digital currency. So, yes, you can get out, but be very careful getting out. I wouldn't suggest getting out for fiat, but there may be a reset before the top. I don't know. I doubt it, but we could see something. It's very hard in these in the end game, as 𝙎𝙊𝙇𝙀𝙍 calls it, and we are nearing the end game because the people at the top don't want to lose power, don't want to lose control, they don't want to lose their monetary status, and they'll do damn near anything to maintain it, and that means more repression on the public at large.
Yeah, and I think, David, the main way that I've looked at that I mean, there's a bunch of ways that that repression can occur. A lot of it is just general fundamental education. We don't talk about these things in school anymore. We don't have an eye on the Constitution here in the U.S., specifically with regards to money. And I think that for the most part, people don't really understand the precious metals, although they do tend to do very well during crisis times. So I do think that there's still that thought about the precious metals being, a safe haven. However, this time being different, and a question I get asked a lot is, what's going to happen, to gold and silver if we do end up going to central bank digital currency system? Because like you said, the central banks really want control of that system. They're the central planners. They believe they can make decisions on aggregate economics better than we individuals can. Of course, I think that ignores individual action, but in any case, that tends to be the central planner's viewpoint. At this point, do you see that they're going to continue this suppression when, the system flips over, whatever it is? We know it's the end of the fiat currency, or at least the current one. Do they have the capability in your mind, David, of keeping this suppressed through all of that? Or do you think at some point the market can overwhelm it and the people will vote with their dollars and go into the precious metals again?
Well, I definitely believe the latter. If you look at the movie Rollover, which I've made reference to many, many times, not so much in the last 5 or 10 years, but when I started on the speaking circuit, Rob, 20-something years ago, I used to have a movie clip about the Saudis pulling all their money out of the United States, and it caused a bank run. And the idea being that in that movie, there's a line that the head banker, you could call him head of the Fed. It's really not clear from the movie, but he could be like a top New York banker. And he says, money, capital, has a mind of its own. It flows where it wants to. You can't control it. Of course, he was trying to control the amount of gold purchases that the Saudis were making and keeping it quiet. And once it got known in the banking community, in the top level banking community, the Saudis were moving out of dollars and into gold. Then there was this big panic to run to gold, and the Saudis cashed out their U.S. holdings and moved it into gold, and gold went sky high, and blah, blah. It's the end of the movie. But the point being is, answering your question, yeah, capital does have a mind of its own, and people are going to go where it flows. I think, of all the, gold community, and I'll kind of branch out to Marty Armstrong on that. I mean, I don't think Marty's nearly the gold bug that some of us are, but he does have a good conception of what I just said, that, whatever the currency market de jure is, the money will float into that currency. Look at what George Soros did with the British pound, sorting it, knowing ahead of time what the outcome would be. So money will flow. And the problem today, and you didn't ask the question, but I like to throw this on the table, is that there's so many derivatives in the precious metals markets that didn't exist when I was, your age. I mean, there was physical metal. There were private options. Makata did some options on metals. And then you had mining shares. And that was it. ETFs, double leverage ETFs, mining share ETFs, not options on futures. I mean, there's so many ways to participate in the metals market without ever touching any physical metal. It dilutes the entire pool by a great factor, some say 100 times. I don't know the exact number. I can tell you what it is on the COMEX, but I don't know what it is at the LBMA because that's opaque. We don't know what the numbers are. So my point being is that if it was 1970, 1980 all over again, there would be a much more concise, precise market. But as I show in the Exter Pyramid, or I should say as I reference in the Exter Pyramid from John Exter, the bigger the bubble blows, the worse the derivative market becomes, the more potential for a catastrophe exists.
I agree with that. And what do you think the difference is this time with respect to earlier periods? That's another question I get all the time. And you kind of hinted at it. There's more derivatives in the marketplace, where we may be going through a currency change, all those types of things. I think that David should affect investors' viewpoint on the metals. Should it at all, or should they just stay the course, and go per the usual script, which is we know there's a lot of risk and people should rotate in? Or are there certain things that people need to watch out for? Do you think there are like speed bumps or other things that people should be aware of?
Well, my answer, Rob, is that I think it's lack of knowledge. I think that my generation saw the silver coinage leave. And, a lot of people, when it first transitioned in 1965, before Nixon closed, so we went off basically the pseudo silver standard in 1965, and very few people were even aware of it. Most people didn't even pay any attention to it, and yet it existed. But there was a subset that did, like all the vending machine owners. They were taking all the silver out and they're restocking them with Johnson slugs. And then we went off the international gold standard. Remember, it was illegal for Americans to own gold from 1933, but internationally, that's how we settled. It was an international market, and of course, that was closed August 1571. So we were totally set anew back in 1971. At that time, I'd say, I'm just guessing now, but maybe one or two out of 10 people were kind of aware of, that gold was in a monetary system, that it was some way or another, it seemed like it was important to be in a monetary system. And there were much more aware. Today, I'm going to digress and give you a quick story, but when I visited the CME, I think it was the first time years and years ago, Ron Santelli was outside smoking a cigarette. And, me, I'm fairly friendly. I walked up to him and said hi to him because I've seen him on TV 100 times. And we kind of had a quick chat. And he asked what I was doing there. I told him I was there to see a couple of my brokers and, get a tour. And I talked mostly about gold, not too much about silver, talked about both. And he said to me, he goes, I don't think gold's ever going to come back. And that really startled me. And I said, why not? He goes, because there's too many other opportunities to invest now that didn't exist in 1980. Mm-hmm. And so I had a conversation with him roughly around 1999, 2000, 2001, sometime in that time frame. I don't remember the exact date. But, it kind of stunned me. But, that guy, he lives it and he breathes it. He's on, the Financial Channel. I really like him too, by the way. But regardless, and that goes back to what I said earlier during this Spaces interview, is that there's so many ways to quote unquote buy metals that really don't have anything to do other than following the price that didn't exist in several decades back. Nonetheless, it doesn't water down what I said about the synergy of events that will conspire or come together. I shouldn't use conspire. I'll get a conspiracy tag from Twitter, but that all these things come together, and there is only very few solutions. And from a liquidity and a payment of last resort method, that means the precious metals. That's what it means. I mean, you can settle in Bitcoin and other things, and that's possible, but they're under gold. So I think it's going to be a re-education. Once the ship is sunk, everyone's going to wish they had precious metals, but they never heard about it. The broker never told them about it. Everyone in their family said, don't buy it, that type of thing. So I think it's going to be more or less after the fact. Now, the run into the metal will be a synergistic event where a certain percentage of the population will wake up, but it can't be 100%. And it won't be. It may be another 1 or 2%, but that's all it takes because these markets are so small. When you really know the rubbers hit the road is when the institutions start to come in. When pension funds come into the gold market, or you hear the teachers union that's come in, or somebody with a bond portfolio sells their bonds and moves into a gold fund or that type of thing. And that will take place. So again, it's a small exit. Not everyone can get through that door once the run begins.
Rob?
Yeah. Go ahead.
Rob, can I weigh in a little bit in support of what David is saying?
Yeah, absolutely. Go ahead.
I guess I'm a firm believer that the internet has helped with the exposure to the metals, especially in the last year and a half, 2 years. We've had this group out of Wall Street Silver convert a whole bunch of people that maybe had never bought metals before. And they succeeded in getting a whole lot of new buyers to come in, and they're just not one-time buyers. The couple of guys that seem to be in charge of that Wall Street Silver, they've been on Chris Marcus's show. I see Chris is in the audience here. They've got their own channel. But in support of what David is saying, whether it's 100,000 buyers or 50,000 buyers or 2,000 buyers, if they're buying rolls of coins or 10-ounce bars or 5-ounce bars, or it's not really going to affect the price of silver that much. What really affects the prices on the futures exchange are flows of funds, and large fund flows affect the price. And in 100% support of what Mr. Morgan is saying, that if the normal percent allocation to metals is 2% of the funds that flows into the precious metals site, right now they might be 0.5%. Well, they'll get back to 2%, but then when things start going, the open interest goes up, and performance chasers might increase that percentage allocated to metals. What if it goes to 4%? You'll see huge increases in the price of gold and bigger percentage increases in the price of silver. That's my opinion.
Okay, good thoughts. And thank you, Jim, for contributing. We appreciate that. By the way, the Spaces is put together so you guys can come in here and contribute. I don't mind if you come and ask questions and state your opinions. That's really what we want. So if you're interested in speaking, I think there's a stick your hand up feature. Please feel free to use that, and I'll have you come on and ask questions. But David, I had a follow-up question for you based on what you said. And it goes back to something that we talked about last year when we were at Silver Symposium and I was interviewing yourself and David Smith from the Morgan Report about silver. We were talking about price targets. And the reason we bring this up is because everybody wants to know what the price target is, right? Investors want to know what the return is going to be and what the potential is. We were talking about $600 silver. Could you take a moment and just let people know where you got that $600 silver? And do you think that that's actually possible in this world? Yes or no?
Well, let me get to where I got it first, and then I'll get to the possibilities. So the first time I heard about $600 silver was when I used to take consultations. I've taken consultations off of the morganreport.com site. I just don't really have time. I may put it back up, but got a consultation from a silver investor, a woman in Toronto, Canada, and she informed me that silver was going to $600 an ounce. And I asked her, how did she know that? And she said there is a guy named Cliff High that had predicted $600 silver. Well, I went into, at the time, George Ure was kind of promoting Cliff High, and I found his website, and I've basically followed Cliff's work ever since. So that's one way I learned about the $600 silver. But Cliff and I did an interview together with, I think it was Beyond Mystic, Jean-Claude's channel. And he had, as I just said, both of us. And what I found out, and I knew actually before the interview, of course, was that John Williams taking the metrics from the CPI of 1980 and applying those to what's happened on inflation, to what silver's high was of $50 in 1980. If you use those metrics, not the current ones, you would have $600 silver. So it kind of verified it in two ways. I mean, Cliff's made the assertion, not Cliff really, but his data has suggested 600. It came up with the data. And then, of course, looking at it from an inflation adjusted using the 1980 metrics, it's 600. And then is it possible? The answer is yes. And the reason it's yes is because during the final phases of a currency crisis, you really can't put a paper price on anything. Now, whether we're going to get there or not remains to be determined. I'm not sure that we will. I think there's going to be enough dislocations in the market that there'll be things that you might want to buy and you have the money to buy, but they don't exist anymore. There may be things that just absolutely go away, and there will be an adjustment on almost everyone's part as far as what is value. So you'll find something that's considered to be sacrosanct, like the U.S. debt markets, and people will realize they're really worthless. And once that hits a certain percentage of the investing public, be it institutional or retail, then it will be a combination. But once it goes to institutional, and of course it has. I mean, if you look at what Russia and China and even Japan have said, look, you guys aren't going to ever pay this debt back. Why should I own it? But they know that they can shoot themselves in the foot if they start to sell off the treasury market too quickly. So there again, we go back to capital has a mind of its own. But when you get panicked and you see that Japan's offloading a lot of treasuries, the trading desk in Dubai sees it and says, oh my goodness, I don't know what the Japanese know that I don't, but I'm getting out of the bond market. So we have the potential for quite a waterfall decline in both the debt markets and in the equity markets, and they're pretty much joined at the hip now. It used to be counterbalanced. If bonds would be countercyclical to equities and vice versa, but that's not true anymore. They're both basically joined. So if you got a big sell-off in the equity market, it'd probably take the bond market down, or vice versa.
Yeah, and that's an interesting point that you bring up, David, and I wanted to adjust a little bit and talk about the economic factors here for a second. It seems to me that this cycle around, there has been a lot of downplaying traditional economic indicators, and I'm talking things like in year 2-year Treasury yield curve inversion, which predict recessions. Well, now that's being downplayed in the media. We have yield curve inversion. Anything below 10-year has a higher interest rate than the 10-year, which is a complete yield curve inversion, and yet we don't hear that being talked about. We've had 2 consecutive quarters of negative GDP growth, which has always been called a recession, but the White House now doesn't want to call that a recession because they think the jobs numbers are good. Where if you look at the labor force participation rate, they're actually 3 points worse than in 2008 before the last crisis. So all the money printing hasn't led to better job outcomes for more people. So it seems as though we used to rely on that in the financial media. We used to talk about indicators of recession and where we are, and now that's all being downplayed. But what could be the reason for that, Dave? Why are people ignoring the traditional indicators of where we are as an economy?
Well, I go back to 1984. I mean, it's the Ministry of Truth. Freedom is slavery. I mean, everything that Orwell wrote, we're watching basically come across the daily news. And it's because, and unfortunately, and you can hate me if you want, it's the trolls control, but America's been dumbed down. And it's not just America, it's really pervasive worldwide. But I think that Americans generally have been taught to believe rather than taught to critically think. And if we're taught to believe, and what comes out of the programming office of the television depends on what channel you switch to. Some seem to be more conservative than others, but the main theme is basically the same, and that is believe what we tell you, don't think on your own. And so that's the real crux of the issue as far as I'm concerned. And going back to our previous question or two, it's like once the silver market and the gold markets go ballistic in terms of paper prices or what their true value is, buying a section of land for 100 ounces of silver or whatever it is, then people will get that lesson after the fact, not before the fact. But if they were taught to critically think or learn anything about money, then we wouldn't be in the position we're in. But, even in high school, when I went through, they don't teach you basics like how to balance a checkbook. I mean, you can teach yourself how to do that pretty easily, but there's no real talk about the monetary system. There's no real talk about finance, how the economy really works. I mean, you learn a little bit about supply and demand. But anyway, I'm droning on. I'll give it back to you, Rob.
Well, I'm glad you made that point, and I want to give a couple of anecdotal stories to that. So I'm a Gen Xer, right? So I was born in 74. And when I went through the school system, they did, like David said, they didn't have a lot of financial education. There wasn't really a standard personal finance class. We did, when I was in 6th grade, talk about having checkbooks. but they didn't really say like how to balance. It was basically you put your information in, here's the register, good luck. There was never anything educating people about money. That's changed a little bit. My daughter is 18 years old. She is a Gen Zer, I guess on the borderline between millennial and Gen Zer. And she works. She works as an actress and plenty of income and has to go through balancing, her statements. And she took a personal finance class in her high school curriculum because they did have one as part of the standard, which is great. But it really taught getting into stocks and bonds. So it was really like the mainstream had designed this investment class or this personal finance class for people, and it was to increase the funnel of money going into these derivative risk assets on Exeter's pyramid, which I don't see as being super valuable. So I thought that was interesting. My lesson, David, for silver came when I was a kid. I went out to the country to see my brother on his ranch. They had different fathers, so went to stay with one of my older brothers. And the first thing he did, David, and now I think I understand the importance of this. Back then I didn't. As soon as I got in his truck and we got to his farm, he handed me a roll of silver dimes. And he said, "This is money, keep it out of the bank." And I was like 6 or 7 years old and I had no idea what the hell he was talking about. But he basically said, "Don't trust banks around here." So I do think that there are people that understand what happened before, and they have a general distrust of the banks, and they understand silver and gold is money. But my goodness, that was a long time ago. And I just don't know if I would see that scenario happening again today. And so it seems to me that it's us, David, that are the educators. I mean, is that what you do? Why you do it? The Morgan Report? Is that one of your missions?
Oh yeah, I mean, I don't want to get too esoteric, but I feel it's my duty, it's my calling, it's my moral obligation, it's my passion. I mean, they're all rolled into one, but I feel, I know my purpose in life, and that's to basically teach and empower people to understand the benefits of an honest financial system. And if we could tell the truth about money, wow, what a concept. Because when you can lie about money, you can lie about anything. And we have. I mean, interest rates aren't a lie. If the free market determined what the price of money is, we'd have a whole different bond allocation, real estate market, the loans on cars and everything else. Everything stems from this funny money, illegal, get something for nothing system that's been created.
Yeah, I agree with you. As a reminder to everybody, if you want to speak, stick your hand up and we're happy to have you ask questions. I know Jim has been in a couple of times already. Feel free to jump in if you want. We don't mind that. We don't mind answering your questions and talking with you. That's what the session is for. One question I want to ask you, David, is basically around what is the roadmap for people going forward in terms of their investment portfolio? There's so much risk everywhere. You've had this broad market sell-off. You've had the inflation. You've had all those things. What do you think is potentially safe going forward? I know gold and silver are obvious answers, but are there other areas in which you're looking at individually for your portfolio you think may be a good place to put money?
Well, always, if you can get a good business, that's one. Of course, it's got to be something you like because, as you know, Rob, when you have your own business, you work longer hours than if you work for somebody else in most
True.
cases. But I'm still not a big real estate investor, never have been. But I think there's opportunities there, but not at this point in time. But it would be something. I think number one is to be educated, and anyone that's on the Spaces call pretty much is. So you kind of know the big picture, and then what you want to do is live within your means and save the rest. And you don't want to deprive yourself of anything, but you also do have to have delayed gratification. In other words, you might have a certain car in mind or whatever, and once you get the money saved up to buy it, buy it. Well, that's fine, but you might be better off investing that money and maybe buying 2 of those cars if you're willing to sacrifice a couple of years of time or whatever. So, not trying to run anybody's life. I'm just giving the idea that most Americans are they're not taught to ask what the price is. They're taught to ask what the payment is. So you go in and see a car and it may have a pretty big sticker on it, but they don't care. It's how much do I have to pay per month in order to buy this car? They don't think of it being 5 years or 7 years, whatever the car loan is. Now, I'm not saying everybody and most people on this Spaces call think differently than that, but I'm talking about the general population and what they've been taught. And that is, well, everything's on credit and everything's on a payment plan. And unfortunately, that's why one of many reasons we're in this state of affairs that we are in.
So, David, I want to chat for just a moment as we get close to wrapping up the spaces. We were going to go about 45 minutes. I think we'll get there in a few. And if anybody has questions, please feel free to raise your hand and come in and ask. I wanted to turn to inflation real quick because I think it's no longer the elephant in the room. When I started talking about this, Dave, at the beginning of the year, I was looking at core commodity prices. And in my view, that was going to cause rampant inflation this year. And we've seen that. And even in the CPI numbers, which I'm not sure anybody on this call or believe are fully true, they're high. They're getting near double digits. There are reports now, Citi just issued reports in Zero Hedge that people are panicking about UK inflation, that we're sitting maybe 18% or higher. And certainly we've seen inflation rage at different other countries around the world. Now, the dollar milkshake theory or the strong dollar theory is that because the dollar is the world reserve currency, it can withstand a lot of what's going on in the rest of the world. It has, the dominant currency, so it should always be stronger than anything else. But if we're truly in an era of de-dollarization, which I think we've seen with China, Russia, and some of the BRIC nations, does that change? And do you see those types of inflation rates coming home to bite us in America, even though we are the reserve currency of the world? Do you think that eventually comes back to the dollar?
It does. And we're already seeing it, of course, with the BRICS nations, and nations are making noises like they want to join the BRICS. And, settlement outside of the U.S. dollar, as we all know, with the ruble for energy and the European market, and China taking payments in other currencies and that type of thing. So the de-dollarization is taking place and will continue. And the trend is it will take place more and more and more. Of course, if you've got a dollar debt and it can only be paid in dollars, then you're stuck, unless you can sell that to somebody. So I do see all currency crises end in failure, and the currency, whatever the dominant one is replaced by something else. Normally, it's replaced by another quote-unquote currency that's backed by precious metal or metals. That may be the case this time. I'm not so sure anymore. A decade ago, I was pretty certain that would be the case. Now I know what the central bankers want. Mark Carney was very explicit. He spoke at the UN at Davos and at Jackson, Wyoming. So he spoke at the UN, the WEF, and at the Federal Reserve and said the same thing. We want modern money theory. We want no backing. We want to print whatever. We want to track, tax, and trace every purchase from everybody. And we want no currency. We want a cashless society. So that's what they want. That's pretty clear. Again, I've said this on other interviews. I do not think that's going to happen, but at least we know what their playbook is. They've opened it up and shown us.
I agree with you. Yeah, we tried to cover that on the channel quite a bit this year in the central bank digital currencies. We were one of the first to write about it back in 2018 when that first IMF blog posting came out. And now I think everybody's kind of got the scent of it. And it does appear that that's the type of system that they're trying to architect. Whether they get there or not, I guess I kind of agree with you. What you said earlier in the broadcast was it has to do with education. If we can educate enough people, perhaps the people can stand up and say, hey, we want legitimate alternatives. Maybe it's Bitcoin, maybe it's metals, maybe it's statewide local currencies, whatever the case may be. We did have a couple of questions. So Jay Hess has asked to speak. So JS, if you're there, can you go ahead and unmute and let us know what your question is? Yeah, how are you?
Hey, just fine. Got the same first name. But
yeah, tell us just real quick before you ask your question, tell us just a little bit about yourself, like where you're from, a little bit about your background so we know where you're coming from.
Quincy, Illinois, which is on the river halfway up Illinois. And I'm a retired UPS driver. Been investing in silver since about 2002. I followed Ted Butler, who got me interested in silver to start with, and got fascinated with the story. And then David, him and I go way back. I was one of David's first subscribers. And I also mentioned to David about Cliff High. I don't know if you remember me or not, but in Georgia, I kind of was involved in that also with you getting contacted with them. And but it's just a fascinating story all the way to this point. My question, I don't know if I got into this list with you guys part way, but did you guys discuss the SLV situation, short positions on SLV?
David, do you want to take that one?
Have not. I mean, I haven't looked in a while, so maybe give it back to the caller. What do you see in the SLV right now?
Well, like Ted Butler's latest report, kept showing a substantial increase in the short position over the last few months on SLV, and I don't understand at all how can they short shares on a ETF that's supposed to hold physical silver for you. I don't understand how they can short it and just leave that short position there without fulfilling their obligation of putting silver into that fund. I mean, I don't understand how they get by with it.
Rob, I see what you're saying, and it's probably going to be talking out of both sides of my mouth, and I really don't mean to. But one, I agree with you philosophically. There should be no way, if it's a physical commodity, you should be able to short something that doesn't exist. However, really, if you get down to the prospectus and you look at it in a court of law, what you're buying is a stock certificate. That's what you get. And you can short any stock on the board. So, in theory, you're shorting that piece of paper. You're not shorting the metal itself. So I don't know how the court would rule exactly. I know that the deck is stacked. There's a club, as George Carlin says, and we're not in it. So that would be my take. Is it morally correct? No. Is it legally correct? Probably.
Yeah. I end up getting involved with the LODE project, LODE, which you kind of highlighted a while back, and they're getting ready to do their big upgrade where it comes full liquidity in September. And I thought you might want to touch on that also.
Yeah, we're waiting for the launch in September, and I don't want to speak out of turn. I am an ambassador. I did put some silver into the project early on and added to it as things got better and better. But the product launch is kind of being developed, but there's going to be more opportunity. One thing I really like about it is these guys never give up. And we are in the process, and I'm part of it, of determining some mining activity where we can get silver out of the ground, gold too, but primarily silver, at a cost lower than spot, which is how a miner makes its profit, right? A gold miner that's all-in sustaining costs make up a number of $1,400, and the price is $1,700. They're making $300 fiat per ounce gross margin. So we're doing that in LODE, which will give us some type of an advantage over time if we're able to mine enough where our premiums could come down relative to other digital miners out there that don't have access to their own mining facility. So that's part of it. What's going to be announced, I can't really tell you. I have to wait myself to put it out there, but pretty excited about it, actually. And I want to make it clear that this is an adjunct to holding your physical metal. It's not like I would consider it to be a primary silver investment or a gold investment, but the liquidity factor is pretty amazing. And the transaction costs to buy, sell are very low relative to what you might do in the physical market. So again, it's the way I think of the future. I think no matter how this plays out with the central bank digital currencies, I think in the future we're all going to be waving our phones somewhere to pay for stuff.
Can I just offer one potential geopolitical risk that I saw last week on Twitter? I think Mr. Morgan commented on it, if I remember right. There was a report, it was probably Wednesday or Thursday, if I recall, that there was a post on Twitter. Sorry, I didn't retweet it, so I can't recall the author, and I've searched for it, can't find it. But the premise of his tweet was that the Chinese and the Russians in some have got a total of a potential 40,000 tons of gold. Well, why would they be buying gold, 40,000 tons between the two of them, if they are behind the scenes trying to develop potential substitute to the US dollar as a reserve currency? And if that in fact happened, the US, I believe, has 8,133 tons. If that partnership resulted in a competitor to the US dollar, world reserve currency, you can actually, everybody in this audience can actually hedge that, a geopolitical risk, by owning gold, or to the lesser extent silver, because if the gold goes, the silver will go as well. But you could actually have a direct hedge to that happening. I'm not forecasting it's going to happen. I'm just bringing it up that I read it last week, and it's a very serious political, geopolitical risk to the economy.
Thanks for asking that, Jim. I was actually on deck waiting to ask about both
By
India.
the way, sorry, Yara, before you go on, this is Yara, who's business partner to Chris, who runs Arcadia Economics. I know a lot of my audience knows her, but I just wanted to throw that out there since she's not on the channel publicly as much. Go ahead, Yara.
Oh, thanks. And hello from the silver capital of the world, everyone. It's nice to spend time with you. And Rob, thanks for hosting this, because I think community and getting together with other silver lovers and people who are trying to, find a better way to do things than what we've been told is really important. So thank you. But Jim, I just wanted to echo, your interest in that, because I've been seeing headlines about India buying a ton of silver, and also what's been going on with Russia and China and the BRICS nations. And so I was interested if that on some level equates to, David, what you were talking about earlier as far as institutional investors. Do countries count in that echelon as well, or what do you think how that might impact the retail market?
Well, Yara, but it's pretty well known that only central banks buy gold. That no one in the banking elite look at silver as a monetary asset. India used to have some gold in their banks, but it wasn't 999 fine LBMA quality, from what I understand on my study of it. But regardless, I wrote a series of lectures a few years back called "What if Silver Were Treated Like Gold?" And I asked the question, if silver was treated as a monetary asset by the central banks, where do you think the paper price would be? But the answer is they look at gold and gold exclusively. But again, as many have said on this call, once gold runs, silver will follow and probably exceed on a percentage basis because it's such a small market. So inadvertently, by the central banks going to gold only, they'll still push the silver market higher, because once the run to gold gets well established and the exponential factor takes off, where gold just keeps going up every other day in rather significant ways, then there'll be a rush into the metals, both metals.
And I wanted to take a moment and just thank David for his time. I know, David, you have another appointment. Thank you for jumping on and being a guest here for our Twitter Spaces. We appreciate it, and we'll let you go. And for anybody that may have additional questions, I'll hang on for another minute or two if you want to comment or have questions or just thoughts about how this went with David. We're doing a new series for some guest speakers we'll do every once in a while on Spaces, which I think will be pretty accessible to people, but it will give them the ability to do like a radio show, to call in and ask questions and interact with our guests. I think it's going to be fun. If you have feedback on how this went, just hit us up on Twitter and reply there, or hit me at robert@goldsilverpros.com and let us know, and we'll continue to do these if it looks like you guys are interested. That being said, as we wrap up and come down to the end, anybody else have any questions? I know, David Pritchard, you've been trying to get in here and ask a question. I've got you queued up. Did you have anything for us today that you wanted to ask?
Yeah.
There you are. I can hear you now. How are
you? Hey, thank you. This is David Pritchard. I am a former Navy nuke, 9 years in the U.S. Navy. I've been in maintenance and engineering and reliability for my whole career. And I have an interest right now trying to sort out, do I just start pulling money off of these stocks, or how much do I trust IRAs in mostly we have in Fidelity and in Schwab. And if the banking system gets in enough trouble, which I kind of expect to see some too big to fail banks just fail, and then who knows how the pieces will be picked up. Are these brokerages that have all our stuff in street names, are they reliable through this process? Because I can't put it in my name if it's in an IRA.
That's a really good question. I'll start off by saying I'm not really qualified, legally, to answer this, and I'll do my general disclaimer. We don't ever give financial advice. We're not licensed to. We don't hold ourselves out as financial advisors or anything like that. So the disclaimer I always have, I'm required to put SEC disclaimer is that, and then you have to do your own research, and please speak to someone who has experience with qualified accounts. There are plenty of people that anybody wants. I can always send a list of people that you're free to research. But to answer your question, I'll just answer with my own anecdote. And this may, you may agree or disagree with this because we have different situations. In my particular case, 13 years ago, when I saw what was coming and I wrote the book, I was so just just almost floored by what I saw, both inside, working for the big four and seeing the mortgage market,
So
and then doing.
it's hard to know. You're really an outsider conspiracy theorist to think that these things could fail.
Yeah, no, I moved out of pensions and 401ks personally. I just got out because I looked at it and said, I don't want any account which locks me in, because if any event occurs which affects the banking system or a brokerage or the general economy, I'm kind of screwed. That was the way I looked at it. I know a lot of brokers may argue with that, but I did have brokerage licenses at one point. I did take the Series 3, 63.7 tests, all that kind of stuff. And I worked for a currency trader, and I felt like I understood the markets. And the more I understood them, the more I saw risk, and that's just my personal choice. But right now, I'll just give you my financial situation. I'm in no qualified accounts whatsoever. I have no long-term investments, including land. I just sold my land. I went completely liquid personally as we transition through this time, because that gives me the best chance at picking the investments that I want, both not only on a return perspective, David, but also on a safety perspective. And because I did that ahead of time, I'm super liquid right now. Anything could basically happen, and I'm okay, because I can always go back and buy something if I want it. I'm not saying that's what everybody should do. And certainly in my case, 13 years ago when I did this, I was in my mid-30s and I didn't have $1 million portfolio at that time. So it was easier for me to say, yeah, I'll take the penalty on my pension, my 401k. It was just going to be a few bucks. And at the end of the day, I reasoned it'll be what I'm keeping will be safer. And for me, I thought that that was a better avenue. For people now, however, that have big accounts and they're in that system and all their retirement planning has been in and around that system, I highly encourage you just to go talk to a tax attorney, or I'm sorry, a tax person. Go talk to an attorney, talk to your accountant, and see what makes sense. If you have a big portfolio, you have to weigh what are the costs of doing all that, because it's not only the taxes you have to pay when you redeem qualified accounts and the 10% penalty, but it's also the potential changes to your tax program. It's also the potential changes as to, will I be able to recover those amounts when I need them? So you have to weigh, is going liquidity better in this environment, or is staying in these accounts better in this environment? In my case, because of my situation, not high balances, I saw what was going on in the world, I chose to get out. All my financial advisors thought I was crazy 10 years ago. Now I think they would have a different opinion. Yeah. But in any case, that's my answer to it. I don't know if that helps you out at all, but certainly something for you to think about.